In this lesson, I'll be discussing how to make a portfolio. A portfolio, in case you don't know, is a combination of all the financial assets that you own. In this context, we will be discussing very specifically about building a portfolio of cryptocurrencies. Now, there are many approaches to creating a cryptocurrency investment portfolio. I'm going to discuss just a few different ideas with you here and some different approaches that you can think about to help form your ideas about how to make a portfolio. But I do want to note, I'm not recommending one of these over the other or to slavishly follow any of the plans that I am discussing here. I am just presenting these different ideas to help create some sparks in your brain to get you thinking about how you might want to build your personal cryptocurrency portfolio. Also, please note that this is only a discussion of cryptocurrency related portfolios and does not factor in all of the other stuff that people traditionally invest in, such as index funds and bonds and gold and real estate or other investment classes. We're just talking about crypto. The first idea is just Bitcoin. The old saying of don't put all your eggs in one basket is true, but most investment portfolios already are diverse with stocks and bonds and things like this. Bitcoin is just extra diversification into what is probably already a diverse portfolio. Bitcoin is also the dominant market leader in the crypto economy. Much of the market tends to move based on what Bitcoin is doing. Buying and holding Bitcoin is probably the best way to get exposure to the entire crypto asset class since it is the dominant force in crypto. So why make your life so complicated by getting 50 different coins? You just buy Bitcoin and keep it simple. One wallet, one coin to watch makes your life a lot easier. However, if you do want to be a bit more adventurous and to go and seek out larger returns, then there is a big, exciting, complicated, profitable, and highly risky world of cryptocurrencies beyond Bitcoin. One possible strategy is to have a focus on the more blue chip cryptos. Now, blue chip is commonly defined as a reliable investment, a term borrowed from the stock world. Now, these are your very well established cryptocurrencies. We're talking about things like Bitcoin or Litecoin or Ethereum here, ones that have a lot of history, a good user base, and lots of liquidity. In general, this will be a rather low risk portfolio, well, for crypto anyway. This portfolio will concentrate on getting top coins only, but with low risk also comes lower profit potential. Some investors are always out there looking for 100x on their investment, whereas these coins are unlikely to offer that, at least at any point in the near future. As an example, such a portfolio might be 50% Bitcoin, 20% Litecoin, 20% Ethereum, and 10% Chainlink. Now, that's just an example. I'm not saying to run out and buy those particular cryptocurrencies, but this gives you some decent exposure to a few different cryptocurrencies and blockchains while still keeping it relatively simple. Next, we have the buy the market alternative, which is a very popular option in stock investing, buying the top 20 stocks or even buying an index fund with the top 500 stocks. And yes, if you believe in the whole crypto market, then you can buy, for example, $100 of each coin in the top 20. Now, this gives you a wide exposure across the cryptocurrency market and, of course, lots of chances to make profits. However, this traditional market strategy can be very problematic in crypto and is not really recommended. One reason is that you will need a lot of exchange accounts to get the different coins out there, and even more wallets to store all the coins off of exchanges, which, while being diversified across the market, means that you then have to do a whole lot of work to set up the wallets, to get the different exchange accounts, and then to keep all of these different blockchains up to date. It's a lot of work. Also, the top 20 in crypto contains some pretty crazy coins, and some of them have some pretty uncertain futures, so that's worth considering. The buying the market option in crypto is definitely not the same as buying the top 20 stocks and carries a very, very different risk portfolio. Another idea which will help you keep a bit of sanity is betting on a chain. So, in addition to a bit of Bitcoin, you can, for example, get some Ethereum and a few Ethereum related tokens. Now, this is a bet on the Ethereum ecosystem that Ethereum will continue to do well and that tokens related to Ethereum will also continue to do well. So, you'll only be buying Ethereum and dApps related to Ethereum. Now, this makes it super easy in terms of wallet management because everything can be stored on one Ethereum wallet, which makes your life really, really easy. It helps you keep focus on the development of the Ethereum chain, and if you only have a few projects in your portfolio, you can easily keep up to date with what those projects are doing. So, just as an example, if we have an Ethereum only portfolio, let's say it's 50% Ethereum, 10% 0x, 10% Chainlink, 10% Powerledger, 10% Maker, and 10% Engine. Now, all the tokens I just mentioned, these are of course based on Ethereum. This kind of portfolio will still be nicely rounded out with a nice bit of Bitcoin. A common mistake that many new investors in crypto make is becoming seduced by every new coin that they hear about. You do not want a portfolio with 50 crypto coins in it. You don't. Don't do it. It's impossible to keep up to date with that many coins. It just is. You're never going to keep them all straight, all the updates, all the things going on. It's too much. Also, a word here on low market cap coins. Please be careful when you start looking for returns outside of the top 20 in crypto. There are indeed some really, really great and underrated cryptocurrencies out there that have very small market caps. But there are also a lot which have basically been abandoned by developers or abandoned by the company that started them, or which have exit scammed or ran out of money or just failed to gain any kind of relevancy or traction. Many of those coins, unfortunately, continue to trade on some exchanges, so please be careful and take your time before buying any obscure coins. While the above ideas will be very informative for you in building your journey of how to make your portfolio, the reality for most crypto investors is going to be something that I like to call the DYOR special. As you go through your crypto journey, inevitably you're going to learn more and more, and inevitably you're going to discover new projects which excite you, which catch your interest. You like the community, you like the vision of the project, what they're trying to do, and you'll add them to your portfolio. And so your portfolio will end up having a mix of cryptos from across the market and across many blockchains potentially. But again, don't go crazy. You don't want to have loads and loads and loads. A small handful of cryptos is more than enough. But welcome to your new obsession anyway. Regardless of how you choose to style your portfolio, the most important thing is, of course, to have a plan. And if you don't have a plan, then get a plan. Come on, come on. And then stick to that plan when you do get it. Don't go around hopping from coin to coin to coin to coin to coin. Take your time. That's how people lose all their money, running around chasing all the hype. Don't do it. Every time you enter an investment, you should do it deliberately and you should consider your exit strategy. Even if that exit strategy is like a moonshot 10 years down the road, whatever that crazy thing might look like, you need to stop and ask yourself, well, what does it actually mean having a moonshot? There's no reason to watch your coin pump by 100x and not take any profits. And not having a plan is often why people don't get out, because they don't know when, because they never thought about when to get out. They just got it hoping for more. More is very subjective. 1%'s more. What's your plan? Get a plan, stick to it. Of course, you can have more modest goals than going for 100x returns. You can just go 2x or a 20% return. 20% is crazy. The S&P 500 only went up by 29% last year. 20% is great. The key, get a plan, stick to it, and be happy with a profit. Almost no one's ever to exactly call the bottom or top of a market cycle. Also, make sure to learn how to protect your liquidity. How much of your investment are you going to be willing to lose before selling? Using a stop loss or even just having a kind of a lower number in mind can be very, very helpful. These are highly volatile, highly speculative assets. Many of them can lose 99.9% of their value. It happens, and there's no glory in riding a coin down for a 99% loss when you can step off that train after a 30% loss and protect 69% of your liquidity. And if you're really passionate about that particular crypto, well, buy it back later when it's worth almost nothing. A quick pro tip to finish off this portion of the lesson: make sure to keep a bit of fiat or a bit of a stable coin like USDC in your portfolio or in your wallet. That way, when you see some opportunity in the market, you can jump in very quickly without having to wait to send money over to the exchange, buy some Bitcoin, etc., etc. Have it already sitting there waiting so you take advantage of opportunities when they come up in the market.